Good morning, everyone. Welcome to this update for global stocks and commodities for the 20th of October. The title this week is Money Flows Where It's Treated Best. And when you stop to think about it, it's a pretty obvious statement. But the problem is for most investors that that's not what they do. They don't stop and think about what kind of makes the obvious sense. Investors get distracted by news events, of which we're just overwhelmed with every day, and also personal biases about what they think should be, how the world should operate. And this causes them to make decisions which are mostly disadvantageous. So this edition is just another reminder about relative valuations of the market, particularly given the environment that we're in. So that's the background for today. So staying invested over the last 5 years, and people have been trying to call an end to this bull market since about 2014. Staying invested has been extremely rewarding, and the odds are that the bull market is likely to continue. Perhaps not at an index level. The index level may just meander up and down and be essentially flat, but certainly at a stock specific level, if you've got high growth stocks that are doing well and growing their business, and the market indexes are at least holding up at worst, then that leaves those stocks free to to do what it is they're going to do. So that's the overwhelming message for this particular update. We'll touch on some of the normal stock and commodity trend updates, and Portfolio Analyst just continues to identify numerous great opportunities, some that I'm throwing into the mix, but also some that are coming from member questions. And one of the real advantages of Portfolio Analyst is that it's the collective thinking power and collective observations of the entire membership, which is benefiting everybody. So that's a very pleasing aspect of Portfolio Analyst. American stocks added another 16 points. I think it was 18 points last week, so another 16 this week, and basically broke the short-term downtrend that had been in place prior to that. So it didn't really amount to very much. Reporting season started during the week in the US, and it started pretty soundly. We've still got a situation, though, where most news events, particularly around the US-China trade dispute, are being given a negative slant. Everything seems to be presented with a negative slant. The positives are being ignored. But despite that, markets just keep marching on. And, that's, as you've heard me say before, you trade what you see and not what you think. And that's certainly been the rewarding way to go over the last 4 or 5 years. And I just ask you to consider one question. If things are so really poor as the media would have you believe, then why is the S&P just a whisker off its all-time highs? That just doesn't make sense for that to be the case. Now, a lot of people I know who are basically fundamentally bearish on the market, that's their orientation, they will tell you, oh, well, of course, valuations are stupid and therefore the market's at risk. But they've been singing that song now for many, many years, and it hasn't come to pass. The other encouraging thing that I found about last week is that the Russell 2000 for small caps rose by 1.6%. So basically more than double what the S&P did. And that's really encouraging, because when markets are getting to the point of going into a significant downturn, it's the small caps that give way first. And it's the large caps that hold the index up for a while, and then it all, the house of cards all falls apart. But breadth in the US is still very, very solid. So I'm encouraged by what the Russell did last week. Now, the US dollar was down very sharply. It had almost got to 100 on the index, but dropped quite sharply, and that was because the data and some commentary from the Fed suggested that that maybe they would be cutting rates again, and that certainly took some relative heat out of the US dollar. The 10-year yield, though, didn't move, stayed around 1.75%. But just remember that number for the next slide, because that 1.75 for a 10-year effectively risk-free yield is important relative to the yield of the overall market. Just some earnings snippets. We started with the banks as normal, the major banks, and they all beat the estimates. All the big banks did. And the commentary from the bank CEOs was also very interesting because they really confirmed that the consumer is going okay. You know, there is no real problem with the consumer in the US, and the consumer is 70% of the US GDP. So as long as the US consumer is going okay, then the US economy is going okay. We also saw some airline results, and they also came in with solid results as well. Now, it's nothing startling, but it's good enough. They're beating the estimates, and that's how the S&P is priced. It's based on an expectation of forward earnings, and these companies are beating those earnings. So every reason for the S&P index to be holding up. If we look at this, the broader picture, and this relates back to the 10-year yield, the 2019 PE ratio, so the expected PE ratio for the results that will apply at the end of this year, is 17 times. That's slightly above the 10-year average, but if you look over the last 10 years, we've now got interest rates that are much lower than the 10-year average. So therefore, you would expect the PE ratio to be higher to compensate for that. So there's nothing overvalued about the US market at a PE ratio level. But the most important one, and this relates back to the title of this edition, and that is that money's going to flow where it's treated best. And the earnings yields, this is not the dividend yield, so this is the total earnings of the companies, is 5.9% for the S&P 500. So you compare 5.9% to 1.75%. Now, okay, there's additional risk in owning stocks, but that's a big differential, and that is what's justifying people holding stocks at the moment, because it's just a better deal than being in bonds. All right, let's take a quick look at the charts. So there's the S&P. We had a series of downtrends. As you can see, I'll just draw them in here. So we form these downtrends for the short term, and we get a bit of a break of the 50-day moving average, which is the blue line. Occasionally we get a break of the 200-day moving average, but we just keep forming higher lows, sequentially higher lows. We don't have any higher highs at this stage, so we're getting a bit of a triangle forming up here. But if you look at the overall orientation, the 200-day moving average is rising. The 50-day is rising and is above the 200, and the index is now back above the 50. And in fact, I think it's back above the 20-day moving average as well. So in the theme of trade what you see and not what you think, the US market is on very positive ground indeed. Let's just look at the dollar index while we're here, and you can see very sharp fall in the US dollar index during the week, and we're certainly back down now to the bottom of this trading range. In fact, we've broken out of the bottom of the trading range, but we did that once before in June, and then very quickly turned around. So I'm not sort of overreacting to these sort of short-term moves, but certainly quite a decent move down in the US dollar. That had the effect, of course, of pushing the Australian dollar higher, but not as much. The Australian dollar didn't go up as much as the US dollar came down. And you can see we're still very clearly in downtrend. We're still well and truly below the 200-day moving average. So Aussie stocks, the dollar 68.54. Our index fell by 32 points, which was 0.4% for the week. But in the same vein that the S&P in the States is holding a positive orientation, then so is our market. So let's just take a quick look at that. So you can see 200-day moving average rising, 50-day above it, and essentially flat. And the value of the index has managed to scramble just back above the 50. My only concerned with the index, and I don't really, as you know, I don't trade the index, and so it doesn't really interest me that much. There's far more exciting fish to fry in the Australian market than the index. But my view is that the banks are still the major contributor in terms of weighting to the index, and I just really can't see from a valuation and earnings growth point of view that the banks can do anything much. They may not go down, but gee, it's hard to see them going up. So I just don't have any expectations around our index and a lot of our top 100 stocks at all. Precious metals, gold unchanged at 1490. I must admit it's holding up better than I expected because the overhang in the futures market still hasn't unwound to any great extent. I guess maybe that's telling us something that there's a lot more people are bullish on gold now than was previously the case. But I would still like to see that that overhang in the futures market get addressed because the gold market remains at risk while that highly leveraged speculative position exists. Now, the thing that I'm really looking forward to is earnings season for the major US gold miners, Newmont, Barrick, etc. And it's likely that Q3 earnings are going to provide quite a large lift in profits. And it's possible that the market is not yet has not yet priced that in, that they will get caught a bit by surprise. Now, the US gold miners are a pretty minor part. They don't get much focus in the States. They get a lot less focus in America than they do here. And therefore, it's quite entirely possible that analysts just really aren't expecting and positioned for what's to come. With the average gold price having risen, productions, there's certainly some evidence that productions have risen in the last quarter, and average costs probably staying around about the same. So we're in a position where earnings could be significantly higher than what the market is expecting. And that's really what drives sudden moves in the market. It's something happens in either direction that the market isn't expecting. So the majors start reporting on the 5th of November. That's Newmont. And then there's, I think most of the majors will be out with their results in the 7 to 10 days following the 5th of November. So that's the window that I think will start to get the market focused back on precious metal stocks. GDX finished steady on the week. It was volatile again. It is jumping around a little bit, but I think over the next 3 weeks or so, we're going to be seeing a good foundation for GDX formed. I would like to see gold come down further. I would like to see GDX come down further. So let's take a look at both of those. So here's, let's look at gold on a daily first of all. So there's gold on a daily chart. So you can see it's quite a tight triangle that's forming up here. And, seemingly not wanting to fall too much further. I would like to see it down around this 1450 mark. If we could perhaps come back and bounce off these highs that we saw here in July, then that would just help clear that bit of an overhang in the market. But if you look at it on a weekly, you can see we had a nice first leg up. We got a relatively short and shallow consolidation. We then got a very powerful leg to the upside, which took the gold price from around 1280, took it up to 1560. We're now getting another consolidation, which will tend to be a bit longer, and then I would expect that gold is probably going to continue higher in that overall trend channel. Now just flipping to GDX, you can see lower highs and lower lows. So we've definitely got a downtrend channel happening in GDX. It'd be great if it got down to around the 24.5, 25 mark, somewhere like that. That'd be, I think, an extremely good foundation for quite a strong run in GDX after that. But anyway, we'll wait and see what the market delivers. Other commodities, copper steady at 260. That was a pretty weak outcome because there would have been quite a boost to copper from the currency with the big move down in the US dollar. So that's a pretty weak outcome for copper, but I guess that's how people are viewing the global growth outlook. It's pretty soft. West Texas crude also eased a bit against the trend with it would have got a good currency boost, but inventories went up. So again, a reflection of perhaps a weak global economy. And as I said last week, it just remains a very difficult sector to negotiate, particularly at the major levels. I don't have any confidence in investing in this market in the traditional way with the majors. I think it's there are a few high growth small caps that show a lot of promise, but outside of that, I think it's a sector best left alone. There's the spot copper chart. As you can see, pretty much flat. Nickel did come off a little bit last week, but it had a sizzling run from $5.50 to in excess of $8, so a little bit of a pause is in order there. So just wrapping it up, and this has been my consistent message now for quite some weeks, is you want to be looking for reasons to stay invested. And I asked the question last week, whether you're a glass half full or a glass half empty kind of person, and I know which one's better and which one's more productive. So I'd really urge you to look for reasons to stay invested. Resist the urge. There's a lot of negativity out there. I understand that. It can be overwhelming. It can be scary. But resist the urge to get out of the bull market too early, because it's entirely possible that this could run for many, many years yet. Japan has been in the situation that it's in of low growth, low inflation for 2.5 decades. Why can't the rest of the world end up in the same situation? Because they're trying to do the same thing. They're refusing to allow the businesses that should fail. They're refusing to allow them to fail. They're propping things up that shouldn't be propped up, and we've got this massive debt. Why shouldn't the rest of the world end up in a situation like Japan, where it just basically limps along for decade after decade? In fact, when you really put all the emotion and the personal bias aside, there's every reason to expect that should be the outcome. So I think overwhelmingly we're probably looking at a low growth, low inflation world, and that's the new normal. And if that is the case, then the way that assets are valued means that growth assets have really got to rise in relative valuation to compensate for that low growth, low inflation world. It's just the way that it works. Portfolio Analyst, just continue to track many highly promising opportunities in Australia. I've never been as excited about the Australian market as I am right now, and have been for the last year and a half. Tremendous opportunities. Yeah, there's some volatility there, but that's just a matter of learning how to work with it. So that's it for this week. There's my contact details for any non-members, and just a reminder, the Portfolio Analyst 2-week trial for $1 is still available. That's it for this week. Cheers.